Trump's trade war is officially on. After the recent roller coaster of American tariff policies and dramatic stock market swings, one thing is becoming increasingly clear: President Trump's strategic view behind these moves. His primary goal? Reducing the trade deficit in order to cut the national debt. However, does the trade deficit cause the national debt? Is it essentially harmful to a country's economy? And most importantly, have you ever stopped to ask, why does the US run a trade deficit every single year like it's on auto-renew? Welcome to Economic Binoculars, your front row seat to the world of global finance, macro madness, and economic truth bombs. Today, we're diving deep into an economic mystery that has puzzled presidents, panicked pundits, and maybe confused you who still thinks trade deficits are just fake news. In this video, we're unpacking 4 most important questions you have in mind. 1. What exactly is a trade deficit versus national debt? 2. The truth behind trade balance. 3. Why is the US trade deficit not a bad thing? 4. Will the US be stuck with trade deficits forever? Grab a coffee, or better yet, import one from Brazil. We'll be running a deficit either way. Let's dive in. Trade balance and national debt are different concepts. It might surprise many people, but the trade deficit doesn't cause national debt. Well, at least not directly. All right, let's start with the basics. In economic definition, national debt. This is the total amount a government owes to creditors. Think of it as the cumulative total of your personal loans and credit card balances. The trade balance of a country refers to the difference between the value of its exports, goods and services sold to other countries, and the value of its imports, goods and services purchased from other countries, over a certain period of time. So, the trade deficit is a country's imports exceed its exports, and the trade surplus is if it exports more than it imports. Easy, right? Now, is the trade deficit a bad thing for a country's economy? It's a simple question, but there isn't an easy answer. Here is why. Imagine your personal finances. You sell handmade candles online and make profits from your online customers, but never buy anything from them. You have a trade surplus with your customers. And then you buy groceries from Walmart with the money you made, but Walmart never buys your candles. Oops, you have a trade deficit with Walmart. Now, due to your trade deficit, would you say Walmart took advantage of you? You know, just like you're taking advantage of your candle customers? The bottom line is that trade is simply an exchange. You pay a price you're comfortable with and receive something of equal value in return. If your earnings from selling candles exceed your grocery expenses, congrats, you are lucrative, or at least your finances remain stable. The same principle applies to a country's economy. A trade deficit doesn't automatically signal financial distress, just as a trade surplus doesn't ensure economic security. Think of it like managing a credit card. Even if you consistently sell more candles than you spend on groceries, you could still carry a high credit card balance, impacting your overall financial health. Here's your summary. The trade deficit and national debt are connected, but one does not cause the other. Reducing the trade deficit would not automatically solve the national debt. The US has been running trade deficits every single year since 1975. That's nearly 5 straight decades of being the world's biggest buyer, and there's no sign of it slowing down. Let me give you a sense of how massive this has become. In 2024, the US trade deficit was larger than the combined total of the next top 5 deficit countries. Yep, America is in a league of its own when it comes to buying more than it sells. So, why does this keep happening? Well, there's no single culprit, but here are the main reasons that keep the US in the red year after year. 1. Americans buys what the world makes. Let's be honest, Americans love buying stuff. From smartphones to Air Jordans, Mercedes-Benz to Christmas decorations, the US imports a mountain of consumer goods. US economy is built on consumption. About 68 to 70% of its GDP comes from consumer spending. Retail therapy isn't just a weekend activity, it's the backbone of the US economy. 2. The US dollar is the world's reserve currency. Because the US dollar is the dominant global reserve currency, other countries want to hold dollars and invest in US assets like treasury bonds. To get their hands on dollars, they sell more to the US than they buy from it. Boom. Trade imbalance. And here's the twist. This constant demand for dollars keeps the dollar strong, which makes US exports more expensive and imports cheaper. It's like a permanent discount for American shoppers and a penalty for American exporters. 3. Foreign investment inflows. The US has something the rest of the world craves: the deepest and most liquid financial markets on the planet. Whether it's Wall Street stocks, commercial real estate in New York, or treasury bonds, foreign investors are constantly pouring money into the US. This flood of capital supports the dollar and further worsens the trade deficit. 4. Cheap borrowing fuels US spending. All that foreign demand for US treasuries keeps interest rates low, making it super easy and cheap for the US government to borrow money. The US spends far more than it collects in taxes, using debt to fill the gap. This massive government borrowing attracts even more foreign capital, further strengthening the dollar. And guess what? Deepening the trade deficit. Alright, let's cut through the noise. We've been talking about how the US has this monster trade deficit year after year. And if you're just looking at that, it might feel like America's digging itself into a bottomless pit. Now, here's the takeaway of the entire video. The point most people miss? Meet the capital account. Every trade deficit is matched by a capital surplus, because every country has two accounts in terms of its bookkeeping. The current account, where the trade deficit lives. This account shows the import and the export. This is the account most people only focus on. For the US, this account shows import way more than export. Classic big red number. The capital account. This tracks all the money flowing in from foreign investments. For instance, foreign governments buying US treasuries, global banks buying Wall Street stocks, foreign billionaires snapping up New York condos, etc. The US capital account is running a massive surplus because all those dollars we send abroad, they come flooding right back into the US economy. Take a look again at that chart of America's trade deficits over the past 30 years. Pretty grim, right? But what if I told you that's only half the picture? So what would the capital account look like if I plotted it on the same chart? Guess what? It would look like the exact opposite of current account. And no, I don't even need to Google it. Why? Because by economic definition, the sum of the current account and the capital account in a nation's balance of payments must always equal zero. That's just how global economics works. Here is the capital cycle. The US buys a lot of imports. Foreign countries accumulate US dollars. Foreign countries reinvest those dollars in US assets like treasuries, stocks, real estate. The US borrows cheaply, thanks to strong demand for dollar assets. That cheap capital fuels more spending and imports. Back to the US, buys a lot of imports. Rinse and repeat. Sounds a bit like a global economic treadmill, right? Except this one is actually running in America's favor. The US sends dollars out to buy goods, but those same dollars race back in as investments, fueling demand for treasury bonds, Wall Street stocks, Silicon Valley startups, and even Manhattan penthouses. If something ever throws the system out of whack, the currency will naturally adjust, either depreciate or appreciate, to restore the balance. That's why, at the end of the day, the books always balance. In other words, if the US government tried to force the dollar to weaken to fix the trade deficit, it might help for a short while. But long term, the system corrects itself, because for every dollar that leaves the country buying imports, another dollar returns as foreign investment. It's like a boomerang, except this one props up the US economy. So, will the US run trade deficits forever? Oh yes, 100% if you ask me. But how can I be so sure? Am I just pulling this out of thin air? Nope. Don't just take my word for it. Take it straight from the Federal Reserve Bank of St. Louis itself. When the US can purchase goods from the world market simply by printing money or issuing debt, it is destined to run persistent trade deficits. The current international monetary system, based on the US dollar as the dominant world reserve currency, and US government securities as the most sought-after store of value, is the root cause of persistent trade deficits in the US. Mic drop, but wait, there is more. Back in the 1960s, economist Robert Triffin already described this perfectly in what's now called the Triffin dilemma. He explained that the country, whose currency serves as the global reserve, must run chronic trade deficits to provide enough liquidity to the world. In plain English, as long as the US is enjoying the perks of the almighty dollar, cheap imports, global purchasing power, massive capital inflows, Wall Street booming, and Silicon Valley soaring, the trade deficits and weak manufacturing base are basically inevitable. Again, is that actually a bad thing? Not necessarily. Politicians love to cherry-pick data, highlighting the trade deficit to stoke economic anxiety or fuel nationalism while conveniently ignoring the other half of the picture. Let's not forget, when Trump was re-elected, the US unemployment rate was hovering around 4% only. If trade deficits were truly a crisis, why was the job market so tight? Sure, many old factories in the Rust Belt are collecting dust. But is it really a crisis? Or just nostalgia for a bygone era? Industrial upgrading is normal for advanced economies. Workers who once assembled car parts are now selling tech products, managing portfolios, or building fintech apps. So let's ask the real question. Do Americans really want to go back to stitching Nike sneakers and sewing polo shirts just to win the trade war? Or these whole abandoned factories thing is just about self-nostalgic wishful thinking? Now, do you still think the US's trade deficit is bad for economy? If the US government wants to fix it, do you think the US should give up the US dollars as the world's reserve currency? Or there is no real issue, so just keep the global and the US economy the ways they are? Drop your thoughts in the comments. And if you found this exploration into trade balance enlightening, don't forget to like, subscribe, and hit that notification bell for more deep dives into economic topics. See you next time.